In this video, I'll walk you through everything you need to understand about Fibonacci retracements and how to apply them alongside price action. So, what you'll gain from this video is: first, the correct method to plot them accurately on a chart; second, how to identify high win rate trade setups using Fibonacci levels; and third, the right way to exit trades to maximize your profits. But before we proceed, if this sounds like something you're interested in, please hit the like button to support more video creation, subscribe if you're new here, and enable notifications. I'll see you right after the intro and disclaimer. Now, let's begin with the basics. What are Fibonacci retracements? Fibonacci retracements are important levels derived from the Fibonacci sequence, which help you pinpoint where a pullback might end. These levels can be plotted using a tool known as the Fibonacci retracement tool. So, why should you use this tool to spot pullbacks? Let me give you an example. Suppose the market is currently in a trend, and you're looking to open a position. We know that the optimal time to enter a position in a trending market is to wait for the trend to form a pullback. Once the price makes a pullback, you can enter a buy position at its end, before the price resumes the main trend. But how can we identify the exact point where the pullback will end? In my previous video, I explained that pullbacks often end at a prior key level. For example, here, you can see the price moved upward and consolidated at this level, creating a resistance zone. Later, the price broke above that resistance and made a pullback. Notice where the pullback stopped, exactly at the previous resistance level we marked earlier. This illustrates why it's widely recognized that pullbacks often conclude at a key level. However, what if the chart looks like this instead, where the price moved up, formed a pullback, but there's no prior key level? This is where the Fibonacci retracement tool becomes useful. As I plot the tool onto our chart, notice how it automatically generates Fibonacci-based key levels. You can see that the price touches one of these levels and bounces upward. It's widely recognized among traders that price often respects these levels. Another example would be the S&P 500 market crash. Here, when we apply the Fibonacci retracement tool, you'll notice that the level identified the exact bottom of the crash. Now, I'll show you how to use this tool on your own chart and how it can help you find high win rate trade setups. If you're on TradingView, the Fibonacci tool is located on the right-hand side of the screen. Click it, and select Fibonacci retracements. For the settings, I want you to match these exact values so it's easier to follow along. Here's how to apply the tool onto your chart. The first step is to identify a clear trend. For example, here we can see the market is clearly moving upward. Once you've confirmed the trend, the next step is to apply the Fibonacci retracement. To do this, you must first determine both the swing low and swing high of the trend. A swing low is the lowest point the price reached before reversing upward. In this case, we can see the price dipped slightly before moving back up, and at that moment, it was the lowest point, so this will be our swing low. Similarly, a swing high is the highest point the price reached before reversing downward. Here, you can see the price climbed, then made a slight pullback, and at that moment, it was clearly the highest point, so this will be our swing high. Remember, for a swing high to be valid, there must be a small pullback at the end of the trend. Once you've located both the swing high and swing low, draw the Fibonacci tool by connecting the swing low to the swing high, then extend it to the right to project the levels. Notice that I'm connecting them at the tips of the candle wicks. Now, as you can see, we have the Fibonacci levels in place. Again, I recommend using my custom settings so it's easier for you to follow along. Now, let me show you how to make use of these levels. Starting from the top, you have your 0% level, which serves as your starting point. Below that 0% are the Fibonacci retracement levels, areas where the price might pull back. The most common retracement points are 38.2%, 50%, and 61.8%, collectively known as the golden zone. However, this does not guarantee that the price will reverse at these points. It can still push through and head toward deeper levels like 78.6% or even 100%. The 100% level is the deepest point where the move can still be classified as a pullback. Here's why: if the price moves downward but stays above the 100% level, it's still considered a pullback, meaning there's a chance it could reverse upward. But if the price moves down and breaks below the 100% level, the move is no longer just a pullback. It's now classified as a downtrend, meaning the price is more likely to keep falling. In that case, you should cancel the trade and search for other opportunities. A key point to remember is that you must treat these levels exactly like support and resistance zones, as areas, not precise lines. So, how do you determine the exact level where the pullback will end? Just like with traditional support and resistance, you shouldn't enter a position simply because the price touches one of these levels. Instead, you must wait for confirmation by analyzing the price action. Let me give you an example. Here, we can see the price consolidated briefly, then broke below the 38.2% level. This indicates that the price is not respecting this level, as there was no reaction, meaning it's unlikely to bounce here. Next, the price also broke through the 50% level without any reaction, again showing that this level is not being respected. As the price approaches the 61.8% level, notice what happens. There's a small reaction in this area, with the price failing to break below it multiple times. But remember, a reaction alone does not justify entering a trade. Price can react to a level and still break through it, so further confirmation is needed. Next, we spot a bullish engulfing pattern, where the body of the second candle completely covers the previous candle's body. This signals that, in addition to the reaction at this area shown by the rejecting candles, we also have upward momentum indicated by this bullish engulfing pattern. To further validate this momentum, the candles that follow are multiple green candles breaking above the resistance at the 50% level. Let's recap. First, we have the price reacting at the 61.8% level, with multiple candles failing to break below it. Second, we have a bullish engulfing pattern signaling upward momentum. Third, we see multiple green candles pushing above the 50% resistance, confirming that upward momentum. Based on this price action, it's likely that the price will bounce from this level, making it a good opportunity for a long position. Now, in case the trade fails, you should have an exit strategy. Place your stop loss at the swing low, and for the profit target, I prefer setting it at the 0% level. As we can see, the price hits the profit target, marking this as a successful trade. Now, moving on, you can also combine existing support and resistance levels with Fibonacci levels to create what's called an area of confluence. For example, here we see the price move upward and then make a slight pullback. By applying the Fibonacci tool, we can attempt to predict the end of this pullback. Again, connect the swing low to the swing high and extend the levels to the right. The next step is to wait for the price to show a reaction at one of these levels. In this case, the price pulled back to the 38.2% level and showed a slight reaction, as indicated by these three candles consolidating at that point. However, as always, a reaction alone doesn't mean it's time to trade. The price can still break through. We also need signs of upward momentum. After that, the price broke below the 38.2% level and moved down to the 50% level. On closer inspection, we can see that this 50% retracement aligns with a previous resistance level, a point where price had previously moved up, then reversed downward. This alignment creates an area of confluence, where the chance of a bounce is typically higher. To further confirm, the following candles are multiple green candles breaking above the 38.2% level. Let's recap. First, we have the price pulling back to an area of confluence, a Fibonacci level and a historical resistance level overlapping. Second, we see upward momentum confirmed by multiple green candles breaking above the 38.2% level. Based on this, we can conclude the price is likely to bounce here, making it a strong opportunity to take a long position. Now, let's look at an example of a bearish Fibonacci retracement. Since this setup is bearish, the first step is to identify a downtrend. In this chart, we can see the price moving downward. Here's where many traders get confused. If you look to the right, you'll notice that the price moved upward before heading down. So, the question is, how do we know this downward movement is a genuine downtrend and not just a pullback in a larger uptrend? The answer lies in identifying the long-term trend using the 200 EMA indicator. In this example, the price is below the 200 EMA, meaning this downward move is indeed a downtrend. Once you've confirmed the downtrend, the next step is to apply the Fibonacci retracement tool. Since this is a bearish scenario, you start from the swing high and connect it to the swing low, then drag it to the right to extend the levels. Next, wait for the price to show a reaction at one of these levels. As you can see, when the price approaches the 38.2% level, multiple small candles fail to break above it, showing the price is reacting to this zone. Then, we spot a green candle breaking through the 38.2% level, immediately followed by a large red candle that engulfs the previous one. This tells us that buyers briefly pushed the price upward, but sellers came in stronger, driving the price back down past the previous candle's opening, indicating strong downward momentum at this level. Let's recap. First, we have the price pulling back to a Fibonacci level. Second, the price reacts to that level. Third, we spot a bearish engulfing pattern confirming downward momentum as price touches the area. Based on this, it's likely the price will bounce down from this point, making it a good opportunity for a short position. To summarize, here are 4 key takeaways from this video. Fibonacci levels act just like support and resistance. Treat them as areas, not exact lines. Always identify the long-term trend before plotting Fibonacci retracements, and you can do this with the 200 EMA. Never enter a position without confirmation. You can combine previous support and resistance with Fibonacci levels to create areas of confluence. That's all for today, traders. Thanks for watching. I hope you gained real value from this video. If you did, be sure to hit that like button. It really helps us out and shows us that you're enjoying the content. And if you're new here, consider subscribing for more trading strategies. Thanks for your time, stay disciplined, stay consistent, and I'll catch you in the next episode.